So today I want to talk about Federal Reserve rate cut and implications of Trump's victory for economic policy. This is pretty important given that things has changed, and we'll see what entails Trump's second term. Now, in the recent development, the Federal Reserve announced a decision to cut interest rates by 0.25%, setting the federal fund rate at 4.75%. Now, this adjustment was expected of the Federal Reserve as inflation stabilized near the target. We have seen that in the CME Fed Watch 2, whereby the 25 basis point cut was expected and the probability was in the high 94%, right? The election victory of former President Donald Trump, however, introduced new challenges for the Federal Reserve's economic strategy, particularly regarding its projections for 2025. Now, before we move there, you have to understand what is the current economic situation, what we are having right now. Now, the Federal Reserve recent rate cut of 0.25% is a calibrated response to the current economic conditions, aiming to support labor and economy without igniting inflation, because they are still pretty worried about the inflation. This is not something that they can rest on the laurels, because anytime this can come in, especially with tariffs. Now, we need to look in detail with regards to the current economic situation and focus on several factors that underpin why the 0.25% cut was chosen over the 50 basis point rate cut, right? So first of all is the inflation trends. Inflation as measured by the Fed Preferred Personal Consumption Expenditure, or better known as PCE index, spiked significantly in 2021. Through a series of rate hikes, the Federal Reserve successfully reduced inflation closer to its 2% target. With the inflation now near this target, the modest 0.25% cut reflects the Fed's intention to ease slightly while keeping inflation in check. Now, that is the key point right now. They want to keep inflation in check. They are worried. They're still worried that what they want to do is that they wanted to make sure this is reduced slightly and not in a way that like the 50 basis point rate cut that they did previously. They want to still keep inflation in check because they are worried that this inflation could still creep in. Okay, we have seen the US 10-year Treasury yields increasing as well. So that is a sign that the market is worried that inflation can come back, especially with Trump's protectionist policies. Now, this incremental reduction minimizes the risk of reigniting inflation while providing a slight stimulus as a precautionary measure. Now, this stimulus here is towards the economy. We cut a bit to reduce the interest that you need to pay, the borrowers need to pay. Now, other than that, the labor market concerns is one of the key points of the Fed. While inflation has been subdued, the Federal Reserve focus has now shifted towards preserving a robust labor market. Although unemployment remains low by historical standards, the Fed is concerned about potential vulnerabilities in employment warranting the recent rate cut. We have seen the latest non-farm payrolls. That is a shock to the Fed. And I believe that they will study it in detail to see whether this thing is a one-off, because it's the low non-farm data, payrolls data, was attributed to the hurricane that hit the US recently. So that's why you saw the drop in the non-farm payroll numbers. So is that just a month thing, and would that increase later on? This is something that the Fed need to study in detail. And finally, the economic growth with a solid GDP growth rate of 2.8% in Q3 The US economy has shown resilience. The Federal Reserve's measured rate cuts help sustain this positive trend by making borrowing slightly more affordable, which supports continued growth and investments while aiming for a soft landing, a scenario where the economy stabilizes without a severe recession. That has been the point of Fed and one of the reasons why they maintain this particular 0.25% rather than the 50 basis point cut. Okay, so the Federal Reserve strategic adjustments, what they've done, what they plan to do actually, was that the Fed initially planned to lower rates gradually, targeting a range of 3.25% to 3.5% by the end of 2025. However, Trump's victory disrupts this roadmap, largely due to his anticipated economic policies. Now, what are the policies that it's really Trump is looking at? First of all, tax cuts, right? Trump's promises to reduce taxes could lead to a decrease in federal tax revenue, potentially increasing the deficit. A larger deficit would require more government borrowing, influencing Federal Reserve policy, as it may necessitate adjustments in bond purchases and interest rate management. Now, proposed tariffs are expected to impact inflation rates, though Trump may think otherwise, but it actually could happen. Okay, so by raising the cost of imported goods, tariffs could increase inflation, affecting the Fed's interest rate strategy as it balances inflation control with economic growth, right? So what are the market reactions and projections? Given these anticipated policies, market analysts now predict that the Fed may only lower rates to around 4% by the end of next year, rather than the initial target of 3.5%. So if in December they cut by 25 basis points, that means next year you will only have a projected 50 basis point cut rather than 100 basis point cut. Now, these are market analyst projections, okay? So, and it reflects the financial community's expectation that Trump policies will compel the Fed to adopt a more cautious approach. Now, upcoming Federal Reserve communications, while the Fed is likely to assert its independence and reliance on economic data, the market anticipates that Powell and the Federal Reserve may need to revise the 2025 outlook in response to these new developments. Now, the most important thing is that the December FOMC meeting, at this next meeting scheduled for December, will be closely monitored. Updated economic projections, known as a summary of economic projections, will be released, offering more insights into how the Federal Reserve plans to navigate the implications of Trump policies. So we need to see during the December FOMC meeting, how's the dot plot like, number one, and how are they going to plan, what the projections for 2025. Now, I believe that Powell will all still maintain the same language, saying that they are data dependent, but this is something, study the dot plot to have a better idea going forward. So as a conclusion, right, what we're going to see is that as the Federal Reserve seeks to stabilize inflation while supporting employment and economic growth, Trump's proposed tax cuts and tariffs are likely to introduce additional considerations into their decision making. Most importantly, if the Fed slows down its rate cutting pace next year and they confirm with the dot plot, that's why it's so important to get to see what is being released in December when they have the projections. If we see that they're going to say we're going to cut 50 basis points, and the rest of the central banks, the other central banks of other leading economic nations, say that they are still going to maintain their cuts, we are going to see US dollar strengthening, and that is one of the important points we're talking for the longer term perspective. Okay, so with that, that's the report for today.